macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Welcome back to your weekly edition of Cook's Kitchen. Last week we looked at market breadth breaking down as the market was breaking down last Thursday. Today I want to show you index charts that have also been leading the way lower while the S&P appeared stable for a few days here. All right, first up, this is the S&P equal weight index. Notice how we lost the 50-day pretty quick last Thursday and proceeded to lose the 100-day. Finally closed below it again on Tuesday and losing it real quick here into Wednesday. Next up, New York Composite, the NYSE Composite. Boy, it gave up its 100-day a long time ago. That's the red line on all these charts. 50 is the blue, red is the 100, 200-day is the green. Look at NYSE is going to bounce off the 200-day. Watch that one as a key breadth indicator. Wilshire 5000, broadest look at the market you'll ever want to take. Looks almost like the S&P equal weight finally giving up its 100-day moving average. And finally, the mid caps looking, starting to follow their little brother, the Russell 2000. The small caps lower, lost their 200-day decisively yesterday, Tuesday, and Wednesday, October 1st, just headed a whole lot lower. All right, looking at breadth can be, there's a dozen different charts we can pull up. Looking at new highs versus new lows. I showed you, I'm going to show you another one of the S&P 1500 high-low percent. But one of the simplest things you can ever do is just look at the broad indexes. Look at the S&P equal weight. Look at the NYSE Composite. Look at the Wilshire 5000, and the mid caps are telling you something here too. So next, let's go take a look at, this is the one I showed you last week, the S&P 1500, which is obviously the bigs, the mid caps, mid cap 400, and the S&P small cap 600, combined 1,500 stocks. I warned last week that when this was getting down to 2%, it was getting into new territory, basically. We haven't seen these lows here. This green band I have circled, that's minus 5%, new highs, minus new lows on a percentage basis for the S&P 1500. We haven't seen those since the corrections of 2011 and 2012. Well, here we are headed for it. This is as of the close Tuesday at minus 4%. I'm sure it's going to hit minus 5% today. Some people might view that as an oversold buy opportunity. But since we haven't had a double-digit correction, we don't know how far this can extend if it can go below 5%. All right, next up, I want to take a look at, I think I showed you this one last week, looking at breadth in the S&P 500 by a ratio of how many stocks are over the 50-day moving average and how many stocks are over the 200-day moving average. I said last week, warning sign that this was rolling over. It was at 74%. Here we are less than a week later, and we're down, this is as of Tuesday's close, we're down under 60%. So if I use this as my oversold indicator, we are not oversold yet enough to buy. I want to see this thing dip down well below 50, into the 40s, to look for an oversold buy opportunity. All right, we need to talk about the Russell. My theme for today is that the machines rule this market and the bears drool, and I'll explain that in a moment. Let's take a look at a couple more charts. Here is the Russell chart I showed you last week. This is the exact same chart, and really we're just taking a long-term view here. Here's this choppy consolidation at the top between 1100 and 1200. Breaking down now, we took out the August lows. Russell is below 1100, touched 1090 this morning, so it's getting into testing. These two lows here were 1082 in the spring and summer for the Russell 2000, and it looks like we're headed towards taking those out. What does it mean? It means that the Russell could still break down to 1,000 and still be in a strongly bullish trend. All right, so I want to talk about this idea that the machines rule the market. I was actually short the Russell and through TZA and let myself get taken out of that position. And this is the constant theme of this bull market is bears keep trying to short, or you try and hedge and you get taken out of the position, and it finally works when the bears have given up, so to speak. So that's why the machines rule and bears drool, because Wall Street, part of Wall Street you have to understand is big banks of computer rooms where the algorithms are automated. Listen, I used to trade against some of the first automated algorithms in the futures market back in the year 2000, and that's where they were really tested and implemented on Globex through the CME futures. Now you've got firms like Renaissance Technologies, Jim Simons, he just hires mathematicians and IT quants, and he has them program their trading systems, and they're just running stocks up and down all day. Now, Renaissance may have longer holding periods, but a lot of the other guys are just in it to see if they can make 2, 3, 4, 5% a day running stocks up and down. And do the big institutions care? No, because institutions are holding for the long term. I'm going to give you a classic example that just happened. Gilead Sciences. Remember in the spring, after that pricing scare for Sovaldi, they're charging $84,000 to cure people of hepatitis C. And a congressman sent a letter, Waxman sent a letter, and so the stock gets taken down from 80 into the 60s, which was ridiculous because there was going to be no pricing adjustment coming from Congress, because that cure for Hep C from Gilead Sciences at $84,000 is a whole lot cheaper than a new liver installed, which can cost about $500,000. So the stock was an incredible bargain at $70, and the short-term algos who could push it down did, and you've seen that stock just come into its own because of the revenue generating power of that company. So that's one example of a big stock, even a big stock that can get pushed around in the short term by the algos. All right, so big picture here, I want to just step back. And I'm still looking for a buying opportunity because I expect a strong Q4 for the S&P 500. Why? Well, because several reasons. First of all, you got the economy and earnings still sound, and that's your supportive base. That's your evidence. What's the technical evidence? Well, after a 30% plus year last year, I don't expect a single-digit year this year. I expect a double-digit return this year on the S&P. Because of last year's strength. That's the way these things tend to work. We've also had a strong year so far, 3 successive quarters of higher highs, and we just had a tremendously strong August. We had that bullish engulfing reversal pattern, which was the month of August. September came back and filled less than half of that. So I expect to find a buyable low here in October that could carry us for the next 3 to 6 months. All right, that's my view of the market, and check back with me next week to see if we found that buyable low yet. I'm Kevin Cook. Thanks for watching.